So hi everyone, I hope you're doing really well. Welcome to this video. So where should you invest? You want the short answer? I would say north of you is probably going to be better than south of you. And if you say that's a little bit too cryptic, Josh, can't you at least give us a region? Then I would say you'd probably have to consider the northeast. If you want thinking behind those answers, then feel free to stay tuned. If you are looking for buy-to-let investing content with a particular focus on families, then you've just found us, hit subscribe and join us. So we really need to answer the question of where we invest from the perspective of what you are going to get in return. Where should I deploy my capital should be influenced by what I'm going to get. And what we'd like to see, or I'm going to try and show you, is that our returns are fundamentally underpinned by the mathematical concept of proportionality. Generally speaking, cheaper properties perform better than more expensive ones. And I'm going to try and use some data now from Rightmove to illustrate that point. I'm going to take two similar properties, both 3-bed terrace properties. And if you're not sure why 3-bed terraces, then see the video I've put in the description for you. In similar areas, and by that I mean they're probably a 3.5 to a 4 on a scale of 1 to 10. But both areas are 75 miles apart. So we're trying to look at similar properties, but just isolate the difference of north-south, the difference of geography in terms of its impact upon our returns and therefore which area we should be choosing. So here we are, we're on Rightmove, and I'm going to take two areas. This is going to be a property that's relatively north in G24 and a property that's relatively south in NN1. These are both areas I'm intimately familiar with. So what would I get in return if I rented out a property in NG24 1SQ? And the answer is on Newton Street, I'd bring in £995. So let's just put that there then for our north property, 995. And the question is, well, what would it cost me to buy a property that would rent out for 995? Back to Rightmove we go. And on Newton Street, again, this is a 3-bed, these are terrace properties, all the other filters are not applicable. Newton Street, I have a property here that's marked for £160,000 and notified us as sold subject to contract. So I'm just going to use that at face value, £160,000 for a rental return of £995 per calendar month. So this now pre-populates. We can see a mortgage. We're going to buy it with a mortgage, interest rate at 5.5%. After the things have been deducted, we bring home in profit £445, £40,000 invested, £445 out. Okay, what about a more southern property that's 75, 80 miles south of us? Down we go to NN1 in Northampton, and here we have a property. Again, it's a 3-bed terrace property. The same filters have been selected. Barry Road, £1,250 I can expect for rental income, so 1,250. The question is, what is it going to require me to invest to get that £1,250? Let's go to NN1 5JE, quarter mile, 3-bed terrace properties. Filters are all the same. Barry Road, here we are, as a property that's now marked as £300,000. It's under offer. I'm going to take it at face value. £300,000 is the cost of that value of that property to bring in a rental income of £1,250. So which one would you take? And the interesting thing here is, this is about, I'm looking at proportionality now. For the house price and therefore your investment, you are having to put in, for the more expensive southern property, 1.9 times more money. However, the rental increase is only 1.3 times more, from 995 to 1,250. So what this shows us is that as the house price goes up in value, rents do not go up proportionally. And I've given this like this so you can go and do it in any areas that you would like to compare that might be relatively north-south to each other. What's actually worse is, because the mortgage is higher, your actual return in terms of your profit figure here, this is half the return of the cheaper property. So you put in twice as much money almost to buy it, but you only get half as much money in real times. The house price goes up by almost twice as much. Rents, however, only go up by 1.3. if rents were proportional, i.e. this rent was multiplied by the same proportion of house price increase, i.e. 1.9 times, then actually the rent should be £1,865. So what I'm showing you, and you please go and do this for yourself, is that rents are not proportional to house prices. A doubling of the house price does not mean a doubling of the rental income. They are not proportional. What we are then saying is that proportionally, rents are better with cheaper houses. So what we see, proportionality sits underneath the drive for cheaper houses because of your return. So the question is then, where are the cheaper houses? And hence my answer, more north of you than south of you, and the most north you can get would be the north of England. And if you see the picture on the screen now, you can see that the cheapest house prices are in the northeast. Doesn't mean you can't invest elsewhere, but proportionality should be your north star, if you excuse the pun, in terms of helping you decide general macro locations. Also then, a little aside, but let's just touch on this because I think it's very helpful, hopefully for you. Cheaper houses cost less in terms of conveyancing, more expensive houses cost more, and stamp duty land tax is going to be cheaper for cheaper properties than it is for expensive properties, because as soon as you go under £250,000, you're in different stamp duty land tax brackets. So properties really you should be considering properties under £250,000 from a purchase and from a rental point of view because of proportionality. Well, what about proportionality in terms of the other return, which is capital appreciation? What does that look like? Well, the money in capital appreciation will always outperform the money you get from rental income. Feel free to discuss that and debate me in the comments if you wish, but generally speaking, you will outperform, capital appreciation will outperform your money you get in rental income. So the question is then, how frequently do your houses go up in value? And what we're really looking at is proportionality, because what we're looking for is the house value doubling in a certain time frame. It's the doubling that we're looking for, and that is, of course, proportionality. So the question is, how likely is it that these two houses are going to double in value? Which one will happen quicker? How likely is it that a property that's worth £160,000 is going to double to become £320,000? Well, is that more likely or less likely than a house that's going to be £300,000 doubling to 600, and how about to 640 and 1.2 million respectively? Generally speaking, cheaper houses accelerate in their values quicker than they do more expensive ones for simple supply and demand mechanics. So again, rental income is better proportionally to cheaper houses. You're going to earn more proportionally through capital appreciation than you are from rental income. And in terms of capital appreciation, because of the doubling, which is proportional, better houses perform overall, all round. Therefore, if cheaper houses are what we seek because of their returns, then you have to look more north than south, and that's our answer. I do hope that you found this helpful, that you can now go and apply the same process that we have just done to your own chosen investment areas that might be just slightly north-south of each other to help you influence which general area you're looking for. Of course, that doesn't answer the question, well, where exactly? If I find 2 or 3 areas that are all similar in a northern area, well then which one should I go for? I'll try and answer that for you in our next video.